Welcome to Brainstorm by Membrane Labs. I'm your host, Carson Cook, the founder and CEO of Membrane Labs. Joining me today is my co-host, James Roth. He is our head of partnerships at Membrane. He brings a wealth of experience from his time at Galaxy, Ripple, and Goldman Sachs. Our guest today is John Glover, Chief Investment Officer at Ledn. John's impressive career spans senior roles in FX sales and trading at TD Securities and establishing Barclays' capital markets presence in Canada. After that, he became a partner at Validus Risk Management. He's been with Ledn since 2021. Welcome to Membrane's new podcast, John.
Well, John, great to see you. Thanks for making the time for us. If you could just kind of walk us through lending markets and crypto, and in particular, if we could talk a little bit about kind of how they've changed and more of the evolution of lending markets, I think that'd be very interesting, and that'll take us to present day.
Thanks a lot for having me. This is great. Happy to be here. So for Ledn, it's an interesting question because we have two facets to our business, being a retail aggregator as we are. So we are the kind of premier retail lender in the space now with the demise of BlockFi and Celsius and Voyager, et cetera. We've seen a huge change in the retail marketplace in terms of lending where we were a relatively small player before they all disappeared in 2023 to now being the kind of biggest player in the space. A lot of those guys got caught up in bankruptcies. Their collateral assets that they posted were lost or haircut significantly. So that took a long time to come back. But since March of this year, we've seen explosive growth in the retail sector. And what that has done is attracted new entrants into the sector as well. So we're seeing more competition come into that space. So that's been interesting. But I think your viewers' focus is probably more on the institutional side. And we've seen very big changes in that as well. Pre Three Arrows and FTX, virtually anyone could get uncollateralized lines from any of the asset gatherers that were in the marketplace, whether that was, Genesis or BlockFi, even ourselves. Unlike Ledn, a lot of them didn't really do their credit underwriting and proper risk management due diligence. So when I say that, we saw a lot of the bigger players that would lend like to Three Arrows Capital without Three Arrows providing any financial statements. Even unaudited financial statements weren't available from them. And they loaned to them anyhow. And of course, that eventually was going to blow up in their face, and it did. The difference between ourselves and all of our competitors at the time was I was brought in to bring in proper credit underwriting, proper risk management. And as a result...
When did you join Ledn? So what year would that?
2021, I joined. Okay. And so it'll be 4 years this coming March. And when I came in, I couldn't believe what was going on. Like I couldn't believe.
You're in the traditional world, this is outrageous. We're not asking for any financials. They're not audited. What's going on here?
Yeah, it was shocking, and it was terrifying. One of the partners in Three Arrows called for I think the fourth time he reached out to me and said, why are you not lending to us? You're the only one in the market that doesn't lend to us. Right then I said to Adam, our co-founder, I said, we got to buy puts on Bitcoin. This market is going to blow up, man. And of course it did. So that's been one of the big changes. Those who have survived are doing proper credit underwriting now. And then beyond just the risk associated with credit is the market risk that was not being managed properly. So a lot of those guys were, like BlockFi is a great example. They were paying yield on any asset, any digital asset. Most of those assets didn't have an institutional lending market. They didn't have any way to generate yield. So they were swapping.
It was highly unsafe, so you're already putting assets at risk.
So what they did is they swapped those assets into dollars or into Bitcoin and then loaned out the dollars of the Bitcoin, taking risk because there was no way to hedge that risk. And of course, that also blew up in their face. So what we've seen change in that is that now the lenders are being much more professional and taking the cues from kind of TradFi. I know we all like to say we're not TradFi and we don't want to be TradFi, There's a lot of lessons from TradFi that were developed over hundreds of years that make a hell of a lot of sense. The borrowers now have full expectations that they are going to have to provide all of that information. They're going to have to succumb to the due diligence requirements. And a lot of the people that were getting uncollateralized borrows in the past are not getting those anymore. And they're now having to collateralize that lending. There are still some out there that can command uncollateralized borrowing, but they're few and far between, and they are the strongest balance sheets in the marketplace.
So, John, you mentioned the role of trust, and I think you talked about some of the pros of the post-FTX, post-Three Arrows world, where lenders are now acting in a more professional manner. The flip side of that coin, or the more challenging side, is when trust erodes in a market, markets tend to sort of grind to a halt. So are you seeing that still restricting business, or are you seeing a change in where there's at least enough trust to conduct business and to have a proper functioning lending market, probably from both the retail perspective and institutional perspective?
Definitely trust is coming back. And I'd say that in many respects, it's come back fully from those who are professionals in the industry. So when I say that, on the retail side, we've seen our loan book grow to levels that are way above pre-FTX levels. We refinanced all the Celsius lenders. We won about 75-80% of that refinancing business. So the trust is back, but the people are doing their proper due diligence as well. They're asking all the right questions. Before anyone takes a loan from us in any significant size, they're asking our CS team all of the right questions, the stuff that they should be asking. And they're demanding a lot more. Like, we have our open book report we put out monthly. We have our proof of reserves that we put out twice a year. Those are things that clients are now demanding as table stakes. And if you don't have them, they have no interest in dealing with you. So that's been a real positive. On the institutional side, there are still institutions that reach out to us that we used to talk to, some that we used to lend to, and they're upset that we won't lend to them now because they're not providing that level of due diligence that we require from them. I can't speak to the trust that others have with hedge funds or prop shops because we don't lend to them. It's not our target audience. I think trust largely on the institutional side and the retail side is back in this industry.
That's great. So trust is coming back, and this time for good reason, because there's players doing it correctly.
So you're not lending to market makers. Who do you...
No, we do lend to market makers. We don't lend to hedge funds. And
to hedge funds, right. Sorry. So, but in terms of kind of other market participants that you're seeing in the market looking for funding, is it kind of what we would typically expect, or has anybody kind of else moved in there? So, Bitcoin miners or other maybe staking organizations. Are there other players that are now starting to step in? I think it's interesting to look at it as far as both from a borrow and lend side. Are we seeing new entrants? Are we seeing different pockets of folks looking for liquidity, or is it kind of similar call it in 2021 when kind of the normal hedge funds were looking for assets to get leverage on? What are we seeing?
We're seeing funds that are companies that are setting up as funds as opposed to borrowing assets. They're having lenders kind of invest into their fund structure. That's been an interesting change. But really where I've seen the change coming from is the people who are willing to fund dollars into the industry, because that's been a big problem for us for years.
Lack of supply. You can't find any money to give. And I'd argue that we're still kind of there. We're still looking for more capital to step in. Yeah.
We definitely are, for sure. When I look back to 2021 and how we were funding our retail loan book, we were doing it by providing earn accounts or growth accounts, we call them here, where people could deposit stable coins and earn a yield and earn a really good, strong yield. And that was all being used to fund our retail loan book. 90% plus of that was US and Canada. And since the SEC stepped in and said any of that kind of yield offering is a security, and therefore we weren't able to offer it anymore, we had to pay all that back. And now we source third-party funding. That third-party funding originally came from our market-making clients who had excess dollars available. So we were borrowing from them. And it was a good deal for them because we were borrowing over collateralized with Bitcoin. These were people who were formerly borrowing Bitcoin from us. So we were effectively paying to lend them our Bitcoin for free. It was good for them, but it was what we needed at the time. We've really seen that morph now. We don't borrow from market makers at present anymore, but we're borrowing from banks, crypto-friendly banks. We did the Sigdom loan syndication that was announced about 3 months ago, and that brought in TradFi players into that loan syndication. And since then, since that hit the news, we've had inbound calls from credit funds, from other asset managers, and from traditional finance banks looking to set up funding relationships with us, again, on an over-collateralized basis. But
have you found those to be reasonable? Like, are they coming in and saying, oh, well, this is Bitcoin we're dealing with now, if they're not in the industry before, and they're going to try to rake you over the coals and, give you some uneconomical terms? Or are they more, are they kind of aligned with the market? Or do you have to educate them and say, hey, sorry, but here's where the market is?
That's exactly right. Educating them not just on here's where the market is, but educating them on why Bitcoin is such a pristine collateral. Because a lot of them, they look at it and they just go, oh my God, wildly volatile. Right. Bitcoin can go to zero. What can we possibly do? Well, it's not the case. We've seen vols come down from when I joined. I think that the 1 month to 3 month vol was about 110% implied vol. Now it's about 50 to 60%. And we've seen it down as low as 35%. So we're getting into vols that are lower than Tesla stock, lower than Meta stock. So they're starting to understand now that this isn't this crazy asset which has massive swings in prices. And also understanding that it trades like $40 billion a day in the spot market and another 100 billion plus in the perps market. And they don't even know what perps are. So once they get kind of down that path of education, they understand that it's a much more pristine collateral and it's 24/7. There's no gap risk over weekends and closed markets. Then they're starting to see this as more of a lower risk lending approach. And then we got rated by a company called Agio Ratings, which is a ratings agency in the digital asset space. And they rated our lending product. So anyone who wants to fund into our retail lending account, they rated that at an A-.
Forgive me, but for the kind of broader listenership, the A- is supposed to be analogous to, a major credit rating agency in the traditional finance world. It's not like they have their own metrics.
No, you're correct. That's a really good question, and you're correct. So this is kind of a Moody's equivalent, and these guys at that shop all come from traditional finance ratings agencies.
So it's an apple. So if you're wading in from traditional markets, you can feel good about kind of methodology.
You can feel pretty good about it, but the feedback we got from everybody is that's great, but who's Agio Ratings? So if you get to Degrees or DBRS, we'll listen to you. So we're now going down that path of getting that rated.
But a step in the right direction nonetheless, because I do think that's obviously missing.
Yeah, exactly. To answer your original question, we're starting to see much more reasonable offers on where we can fund. So we're talking like SOFR plus 250 to 350.
Oh, wow. Okay.
With the guys we were talking to originally, the credit funds, they were coming in and they go, well, our target is 15 to 17%. So we'll lend you there at a 62% LTV. Right?
Wrong address.
Yeah, exactly. You must be mistaking me for someone else. And one of the big bulge bracket investment banks came to us and they go, we've got $1 billion available to lend, and we are really keen. We'll lend it to you at SOFR plus 1,100. I'm like, fantastic. Thanks for letting me know. How much have you guys lent so far? And they go, nothing, strangely. No one's taking this up.
Wonder why.
Yeah, but it is coming. And that's a really good sign that we're starting to see players come in and recognize this.
Rewinding just a little bit in terms of Bitcoin, are you seeing folks kind of staying away from Ether as a collateral asset? I know Ledn is kind of more focused on Bitcoin in general, but I'm curious if that's come up at all.
Yeah, that's a really good question. And you're right. So if you think about certainly the traditional finance people that are coming into this space now that are starting to educate themselves, they were first educated in preparation of the ETF release in the US, right? So they were educated as Bitcoin as a digital gold. They could understand that. They ran it through all their risk metrics and they kind of figured that out. Then ETH came in and, the ETH ETF was underwhelming. And it was partly because all these guys had their kind of logic and understanding around Bitcoin as digital gold. And now you've got ETH, which is an infrastructure kind of digital asset. And they didn't really have the ability to do the analysis because it was released a lot faster when it came out. And so it really didn't get taken up as well. And on the lending side as collateral, these guys only want Bitcoin. Some of them will take ETH, but they do haircut the ETH. And I think that's from a lack of understanding. And from us, when our retail side of the book, we accept both Bitcoin and ETH, but 95% plus is Bitcoin because people can earn a yield staking their ETH. And so even though those yields are pretty low, they'd rather hold on to that stake, earn some yield, and then post their Bitcoin as collateral against loans. And we're finding that with the institutions as well. They're just much more comfortable with Bitcoin.
Do you think it's mostly a narrative-driven problem at the moment with ETH? Like, would there be more demand if it was easier to encompass in a report like digital gold?
That's a great question, Carson. I'm not really sure because, we're definitely seeing ETH underperform Bitcoin and some others as well. And I think that's because it's just not as clear-cut a definition of what the asset is. It doesn't have, the 21 million that are ever going to be mined kind of thesis behind it. So I don't know that it's a narrative issue only. I think it's a structural issue with the asset itself.
And then as a secondary question to that, I'm guessing, and I forget what the name of the ratings agency that you had mentioned earlier, but you probably haven't seen one where they've ranked ETH. I know you mentioned for Bitcoin the A-, but have you seen any where they try to put a ratings on ETH lending?
Well, so that rating they put on us was on our portfolio of lending, the retail lending and the structure of the retail lending. So it wasn't on Bitcoin-backed lending specifically. It was on our lending, which is Bitcoin and ETH. And we do have some ETH, as I said, but not a lot. But I haven't seen any other ratings of any kind in the marketplace. I believe ours was kind of the first one that was done.
Got it.
So it seems like, banks are coming in, they're looking to be a source of capital for you. Are you getting on the borrowing side? Who do you predominantly see kind of coming in looking for liquidity?
We don't lend dollars to anyone because our growth in our retail loan book is sucking up all of the supply that we have. And that's growing so quickly that we continue adding to that supply and it continues being taken down. But when we're approached by market makers, we've been approached by miners, we've been approached by hedge funds, all to source that liquidity that they're not able to get. Most of them are still looking for uncollateralized, which we won't do. And then, some of them are looking to collateralize, but they want the collateral assets held in third-party trust so that it's, not being rehypothecated, which is fine, which we wouldn't do anyhow. But it doesn't work for us because we would have to have access to those collateral assets immediately upon hitting a liquidation threshold. And on the Bitcoin lending side, we've been approached by a number of interesting kind of option structuring houses that are providing hedging structures to the mining companies, but the miners won't allow them to take the collateral. They'll have it in third party. So therefore, they don't have the collateral assets to post to their hedging partners. And so they've been coming to us on that. But that becomes very difficult to do because their own balance sheets are not very strong, and we don't have access to the collateral assets. So we've seen some interesting kind of structures come up recently.
On the retail side of the book, call it or 2021 till now, is it a different average loan size? Are people using these loans for different purposes? On the retail side, the growth, what's the dynamic there?
For Ledn, and I can only speak for our retail loan book size, but for us, our average retail loan is $26,000. So it's very small. And we've been seeing that grow. And I think the reason we're seeing it grow is because the value of the collateral has gone up with Bitcoin prices. You can borrow more with the same Bitcoin. So I think the last month, our average size was around 35 million, but we have loans as small as 500, which is our minimum loan size. And we have loans as large as 4.5 million, I think is our largest loan that we have on the books. We have two very different kind of profiles of borrowers. The average retail, the smaller guys, they're borrowing because they have an immediate need for the cash, whether it's to buy a new car, whether it's to pay, student debt, whether it's to go on a vacation.
Everyday use cases, general. Yeah. Okay. So it's so not too much has changed in that regard.
We're seeing a lot more high net worth come in now that are using this to buy properties, often using it to invest in more Bitcoin. We have a product called B2X, which allows you to post your Bitcoin, borrow that same amount in dollars. We use that to buy Bitcoin immediately, and that becomes part of your collateralization. And that's really a way to double your Bitcoin for a move that you're anticipating. And we're seeing, large sizes come through for that, which we certainly have been into the run up of the election, with a lot of people expecting we're going to see a big move back up. We've seen some of those people take their profit now that it kind of hit the previous all-time high at the 73,000. We saw some people close those out that had taken them down in the 50s. But really, to us, nothing's really changed. We're just seeing a lot more come in because, kind of we're the only ones who survived that deluge of 2023.
You mentioned the two use cases, one being kind of the everyday needs like buying cars, et cetera. And then what was the second use case often that you're seeing for the borrowers?
So it's larger kind of purchases. So a lot of these Bitcoiners that have held their Bitcoin for a very long time and are quite Bitcoin wealthy, maybe don't have a whole lot of anything else, they need to tap into that to provide liquidity to buy a house or buy a cottage or make a big investment or to buy more Bitcoin. That's kind of what we've been seeing. One other interesting change in this marketplace on the supply side on Bitcoin, because we've been talking about dollar lending, which is really interesting, but there's a lot of Bitcoin that's looking to earn yield, is with the demise of Genesis and BlockFi, who were kind of the two bigger players where you could lend them your Bitcoin, they generate yield for you by lending it out. When they disappeared, all of a sudden those really large supplies that were coming from family offices or maybe some high net worth individuals who had quite a bit, they were looking for somewhere to put this now that was trustworthy. They started going directly to the kind of the larger players in the marketplace to lend to them, whereas they would have been lending through Genesis before. They're now lending direct. They're earning a little bit higher rate because Genesis isn't taking their piece, and the borrower is paying a little lower rate, again, because Genesis isn't taking their piece. We're seeing corporate treasuries, like Michael Saylor said he wants to start earning yield on his Bitcoin. I know there's a Bitcoin bank out there, kind of like, formed kind of like Genesis. It was somebody's very big holding. He formed a company. He formed his own bank. He's lending his Bitcoin out now, and he's got 30,000 Bitcoin.
Are you guys looking at anything sort of on-chain for developing, or is it really just still in the bilateral markets and, in more traditional kind of ways of generating yield, maybe basis or otherwise?
When you talk about out of the ordinary, you're probably talking about some of the DeFi stuff with some of the layer 2 staking and things that are going on in Bitcoin. We don't get involved in DeFi at all. It's just not in our DNA. And also, when you look at the LTV that's locked up in those layer 2s now in Bitcoin, it has gone from like 20 million last year to 1.5 billion. And only about 5% of it's being utilized for anything.
So that's the DeFi angle. On the exchange side, are you seeing people, even if Ledn isn't active on this, are you seeing appetite or requests on the borrower side to do unique structures with exchange-based liquidity? And if so, is there enough out there that makes you explore that if you are getting demand for that?
We've been approached by a couple of different people for generating yield on Bitcoin in interesting ways, through SPV structures, fund structures. A lot of those are just kind of covered call structures that are being wrapped up into something else. A lot of it is basis trading, again, being looked at in some other fashion. But recently, we've been approached by a few people to do some interesting things where you're swapping your Bitcoin into, say, euros, hedging that currency risk and the Bitcoin risk through the perpetuals or through the futures market or FX through the forwards market, and then investing that into funds that look at other kind of unique ways to generate yield on a principal protected basis. And so when you strip out all the costs of that, you're back down to almost the institutional lending market yields, like kind of 3 to 6%, but in a much more risk reduced way. You're not taking on credit risk. And you do have insurance from a known insurer in Europe for the principal protection side. So we've been approached on a lot of those different kind of structures, but most of them are all theoretical and none of them have really generated yield yet. To do it, it's all been based on paper kind of trading and investing. But it's interesting, and some of those are becoming more and more interesting to us.
When you guys think about tail risks or things that would cause you to curb some of your lending activity or otherwise, what are you guys looking at? Would it be an uptick in volatility of the underlying assets?
We look at tail risks all the time. I mean, that's something that we focus on very strictly here at Ledn to make sure that we're going to survive the next debacle that happens. And there will be one, just as there is in TradFi. They just seem to happen a little bit more frequently in digital asset space, but they'll be further between going forward, I hope. We are without a doubt correlated to Bitcoin price direction, not prices, but price direction. So even at these higher levels of price, if Bitcoin starts to trend lower, our demand tends to go down. And that's just, part of the business. And when it comes to the other risk for the business, it's credit risk. So it's credit risk to institutional borrowers that we're lending to in the space. And so we monitor that as closely as we're able to, because most of these are not public companies. You can't, monitor audited financials that are publicly available. But we have very, very strong relationships with our borrowers. And so we're in contact with them all the time. And they have an open kind of book policy to us that we can see their financials. But what we can't see, because they all consider this part of their intellectual property, is where those collateral assets are all sitting. We know they're sitting on exchanges as collateral to allow them to do their market making on those exchanges, but we don't see the concentration. We don't see which exchanges they're on and what amounts. And so we monitor the exchanges very closely as well to make sure that they're all in pretty good shape. But that's what keeps me up at night. And we do have a team that is monitoring the legislative and regulatory changes in the different countries in which we operate, but also in which our institutional market making clients operate, just to make sure that we're ahead of any kind of big changes that are happening. Things like the MICA regulations that are coming up. And are we prepared for that? And are our institutions prepared for that so that, we can forecast what's going to happen to our revenues and our kind of supply to demand curve?
Obviously, Membrane, we have our own technology that helps folks around their lending operations. But in terms of further advancements in the technology around zero knowledge proofs or otherwise that would be able to give you comfort, are there any sort of technological advancements or pieces of software that you're looking at to enhance your operations?
We're hoping that there is going to be some of those zero knowledge proofs that are going to be coming out that are going to solve for that problem. You guys have helped us a lot on one of the things that we used to spend a lot of time doing, which is kind of monitoring our loan book cash flows and our LTVs on our loan book and all of those things that we were doing via spreadsheet before, which was just way too dangerous and volumes were too high for that to make sense. You've solved for that. So that now is not a focus. You've been able to solve for that. So we're hoping others will come in to solve some of these other problems that we still have. But, when it comes to credit exposure, it's never going to be perfect, just as it's not perfect in TradFi.
So, John, are you seeing any changing trends with the structure and parameters of your lending book in terms of collateralization, tenor, et cetera? And if so, how is that changing?
Most people have had interest in open term loans. That's what most have wanted over the past couple of years. But now, because of the scarcity of lending and scarcity of dollars, people want to have longer term lending. So people are looking for kind of 3 to 6 months. And that's interesting from our perspective. And it's tough for us to, like, if it's Bitcoin, it's near impossible for us. But if it's dollars, we could do it. But one of the things that people aren't factoring in is where the funding's coming from and what the tenors are in that. And when I say that, when we look at the TradFi guys we were talking about and the stuff that we're seeing come into the marketplace, these guys are looking 1 to 3 years. So they have no interest in lending shorter term. So all of a sudden, the funding that's coming in is going to be much longer term than the lending that's happening within the ecosystem. So you're going to have that kind of tenor mismatch risk that may arise. And I think that's going to be where we probably see some problems come in the future, that a lot of these lenders are going to be tenor mismatched in a big way.
And in addition to that, have there also been mismatches in terms of fixed float, or because you were quoting SOFR plus, but in reality, back to 2021, it was all fixed. So can you talk a little bit about that?
So the Signum loan was the very first floating rate loan that we, from a funding perspective, that we did in the marketplace. And we've since been able to negotiate a lot of floating rate loans with our other funding partners, which have been really positive because, as we all know, the Fed is cutting lower. Yeah, so we're happy to be having it right now. But the demand in the marketplace from the institutions is still for fixed borrowing. So unless you're going to be able to, hedge that fixed floating through a swap, an interest rate swap, which I think that most people in this marketplace are not in a position to be able to do because they don't have the collateral to post against that, nor do they have necessarily the knowledge to be able to do it. I think there's going to be some mismatches not only in tenor, but to your point, in fixed versus floating as well. So I think there's going to be some maturing growth pains that are going to happen in this marketplace as it becomes more TradFi-like. But I think that also opens up opportunity for those who know what they're doing as well.
Thank you so much for your time. I think this was very informative for us, and I'm sure it will be for our listeners as well. And as always, it's entertaining and interesting talking with you. I always learn something.
Yeah, such a pleasure, John. Thanks for taking the time.
Pleasure for me as well. Thanks very much for having me.